We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Hunter, Contrarian macro strategist with 48 years experience. Thanks for joining me today, David.
Yeah, thanks, Tom. Thanks for having me on again.
It's always great to speak with you, and of course, we have a lot of interesting stuff to get through here today. But I recently saw a tweet that you put out talking about the semiconductor stocks having both a growth and cyclical component, and I wanted to kind of get your thoughts on what type of cycle affects them, and what is let's say the timeline for each of these cycles.
Sure. Semis are kind of I consider them they are the technology what say steel and copper and iron ore are to industrial. So they are the commodities of the tech side. There is definitely a cyclical component to them. Certainly companies like Micron, Texas Instruments, their orders really balloon when you have a strong economy and get cut when autos and things like that are down. So, semiconductor chips are into everything now. So there is definitely a tie to the economy. But on the other hand, they're also very technologically oriented. And so some of it is growth oriented. They're going to continue to be a bigger and bigger part of our economy and our society as we go forward. So that's what I mean. They do trade with the technology side, but they also have some of that cyclical component. And with us really looking at the market from the standpoint of growth versus value, and growth plays when value doesn't, and value plays when growth doesn't. Semis kind of walk in the middle of that, and they get some of the benefits of tech and some of the benefits of the cyclical growth. And by the way, I think in this next melt up, I think both growth and value are probably going to play. We've kind of rotated back and forth in the past 6 months, but I think we're going to see here that both play. So, semis will get that benefit too.
Mm-hmm. So as we've seen a massive semiconductor shortage in the world right now, So does this play into the growth part of the equation for you?
Well, it's probably both. I mean, again, it's the shortage is because we opened up so fast. We went from total shutdown to opening up, and you just don't have the inventories to satisfy. And don't forget, we've had for many cycles this just-in-time inventory. We moved to that probably back in the 80s. And so we got caught here with very short inventories because they kind of assumed normal demand. And, with all the monetary and fiscal stimulus, we went way beyond normal demand. And then you went from total shutdown to opening up. You got pent-up demand growing, pushing demand. So all of a sudden you got this real shortage. I think that's probably as much can be explained by the pandemic and some of the inventory management as anything. But there is also a growth component because chips are becoming a bigger part of automobiles, a bigger part of washing machines, a bigger part of everything. Mm-hmm. And obviously with the shutdown, we became even more dependent on tech. So that's another story. There is you're moving to a much more virtual world where again chips are going to be in big demand.
Mm-hmm. So, David, every time we speak, we talk about the melt up that you foresee happening in the markets here. So what do you base the targets of, let's say, 5,000 S&P, 40,000 Dow, $18,000 or 18,000 NASDAQ? What do you base these on? Are they historical precedents that inform this type of market behavior?
Not really. It's really looking at, technicals, fundamentals, kind of where we are in terms of sentiment, what the macro looks like, and then just kind of looking at a general ballpark of what that probably feeds into. I don't want to say it's seat of the pants, but it's not. There's no scientific data-driven methodology there. I've been pretty good on it this cycle, but it's not, there's no magic to it.
Hmm. So why have you recently raised these targets as well, David?
Partly because we did have the rotations, and I've seen the sentiment stay pretty restrained here, and it just tells me there's more legs because amazingly, you have a market that's more than doubled in at least from a standpoint of the NASDAQ, and almost doubled in the Dow and the S&P. And yet what I see out there is an investor that basically keeps talking about the top being here, nervously in the market. But, everybody can, as you saw this past week, all you need is a couple of days of sell-off, and people are right back to saying, hey, maybe we saw the highs. This thing could go down, 10, 20, 30, 40% in a hurry. So that tells me you've got a very nervous investor out there. That wall of worry is very much intact. And that just argues to me that you've got more upside.
So what happens when we hit these targets, David? Do we see a sharp correction or a drawn out grind lower?
Yeah, I talk about letting it play out. There's no one way it can top out. So you could have, a top be there for a day or two and reverse pretty quickly and be down, in the first step down in a hurry, and then, then have a sell off of 10% or who knows what, and then a rally back to retest and not get all the way back. You could stay up at the top for, a matter of weeks before you roll. It's hard. It's impossible to know, frankly. But I do think, and again, I can always change my targets again. I've always said up until now, my targets were conservative, and I wouldn't be surprised if they were exceeded. With these numbers, I'm not so worried about that. I really do think these are aggressive numbers. I think we'll hit them, but it doesn't mean they're going to precisely be right, and we're going to turn on the dime and go down. That's part of what you have, certainly on Twitter and elsewhere, is people see a number and they think you can invest to that number, it's going to hit, and then very predictably go the other way. And that's not what a forecast is. It's saying this is the ballpark. I'm pretty comfortable with my numbers, but who knows whether you reverse it. Well, let's look at bonds this week. We got down. I had a number of 120 as a target on the 10-year, and it overshot that a little bit, which I'm not surprised by, and got down to 115 or thereabouts. Now you're back up to 130, and you're only a couple of days removed from that 115. So in that case, it reversed pretty quick. My guess is you'll probably from some point make another run at 120. I don't know whether it only goes to 125 or goes back to 120 or it doesn't, but it's not unusual to get a quick sell-off and then another run and just fall short. And then, if you fall short and start rolling over, then you have more confidence that, hey, we've probably seen the highs. I think equities will be very much the same thing. It's possible you tick up and then you just, something happens and people get very negative very quickly, and you're down in one big step, 15% or something. But more likely you get some sell-off, and then you go back the other way and so-called retest the highs at probably a lower high. And then I think you see, from there, pretty fast unwind.
So is there some type of catalyzing event that will spark this global bust, as you call it, David?
Well, I think there are certainly things that will be contributing factors to it. Probably the biggest one being inflation causing the Fed to tighten. That would be my number one candidate for what triggers the bust. And I just think we have an economy, because of the pandemic, as well as what we were doing before the pandemic, a very leveraged, very high risk economy that because of the pandemic now has much less resiliency than it had prior to the pandemic. And it just doesn't have that ability to withstand a lot of tightening. And yet inflation is going to force, I think, the Fed to, they can put it off for so long and then say, hey, we've got to respond to this because inflation keeps heating up. I think that's coming before the end of this year. And if that's the case, they're going to be forced to tighten. And I just don't think it's going to take a lot of tightening to start causing problems in both the economy and the market. And people say, well, yeah, but won't the Fed come back around and just stop tightening and start printing again? Well, inflation doesn't just stop on a dime either. They're going to be caught between a rock and a hard place. So they're going to be caught between inflation that doesn't seem to want to stop accelerating and a market telling them that it doesn't have a lot of resilience to that tightening. And they're going to have to choose between those two. They may initially choose to let up on the tightening, but I think very quickly they're going to say, hey, that didn't work. Inflation's still heating up. So, again, the Fed's not going to have an easy time of it once this really starts coming.
Mm-hmm. So do you think that the housing price boom that we've seen in recent months will also kind of extend into that timeline?
I do. I think we had a respite here in the last couple of months. Rates ticked up obviously to 175 on the 10-year. That pushed mortgage rates up. You had an overheated, at least in the U.S. and I think elsewhere, an overheated housing market. And it caused people to kind of back off and say, I just can't, I was willing to chase, but I'm not willing to chase this far. The cost of the mortgage is up and the cost of the house is up. So you had a pause. I think now that you've brought rates back down, that's probably going to stimulate some activity here of those that were interested but just backed away. So I have a feeling we're going to see a second wind in housing here between now and the end of the year. And probably the same story with autos, with rates down. So I think that's part of why I think you reaccelerate the economy here.
David, are there any safe haven assets in this bust scenario? Does everything just get slashed lower, and maybe what rebounds first?
Yeah, the safe havens will be, I think, treasuries and the U.S. dollar. I think you're going to see, as much as everybody's negative on the dollar. I don't mean, from a trading perspective here, but I mean generally, people think the dollar is losing its clout, and people are losing faith in the U.S. What I think we'll see is what we see at in every crisis. Is people will run back to the dollar. People around the world, investors around the world, will run back to the dollar as the safest currency in the world. They see our country as more stable than elsewhere. We have our problems, but bigger problems overseas. So I think that will put the dollar. I am looking for a dollar decline here, maybe down to 85 or even 80 on the index. But from there, I think a flight to safety will push the dollar up during the bust to as much as 120, maybe even as high as 140. So that's one of the assets that I think goes up in the bust. The other one, as I said, was treasuries. And I do think you'll see a 0% 10-year treasury in the midst of the bust, just because there are so few places you can run and hide. And, if the bust is going to do what I think, which is taking an inflation problem and bring it to a deflationary situation, people are going to run to the one thing that's government guaranteed, and where if you're in deflation, even a very low interest rate or no interest rate is a real return. Mm-hmm. So those are the two places I think do well. I think the market's going to be a very broad sell-off. Certainly utilities will get down less than, technology or industrials, or energy, those kind of things. But I think everything goes down, and pretty much everything goes down in the equity market.
What would be some of the downstream effects of the dollar getting up to 140, David? We've heard that or I've heard before that would really break a lot of normal, systems and trades in the market. So what would the downstream effects of that be?
Yeah, first, I don't know if it'll get that high.
Mm-hmm.
It may only get to 120, but I do think 120 is realistic. And if it gets there, it's going to be there momentarily. I don't think we're going to see it there long enough to cause much damage.
Okay.
It's certainly, I think, as always, these fiat currencies, the real story is not just that currency, but it's the other currencies it's trading off of. It's a relative trade. I think it's more of a story about what's going to happen to the euro. I mean, I think Europe is really going to be the story this time, like we were the story in 2008-9. Again, I'm not forecasting this, but you have to wonder if the euro can survive this, the bust. You've got countries in Europe that are bound by what goes on with the euro. They, particularly Italy and Spain, that didn't have the luxury of saying we're going to just devalue our own currency and pull ourselves out of this. Germany can handle it. Maybe France can handle it. I don't know if Italy and Spain can handle it. And obviously the euro, part of the euro going down as far as the reciprocal of the dollar is that whole story. But I wonder, is the euro going to be able to stay together in that? So that's, I think the story is not just the dollars, really, some of these other currencies.
So how do gold and silver perform in the bust, David? Will the miners behave differently, and are they, let's say, a leader or a follower to the metals prices?
Yeah, well, I'm of course looking for 2,500 on gold and 4,550 on silver before we get to the bust. So they're going to correct, but they're not correcting from here. They're correcting from much higher levels than this, and they could end up coming back to where we are today. What I do feel is wherever they correct to, it'll be far less in terms of the downside than what we'll see in the equity indexes. So if the equity indexes are down 70 or 80%, maybe gold and silver are down, less than half that, maybe a third of that. The miners certainly will be hit harder than the metals themselves, but I think they will probably turn much sooner than the rest of the market, because the response to the bust is going to be on the part of every central bank, money and more money after that. And, there'll be a knee-jerk reaction, or certainly what I think ultimately is a correct reaction, that you got to own gold and silver.
Mm-hmm. So considering these, let's say the $2,500 gold target and the $45, $50 silver target, are the same fundamentals going to drive the prices to that point that are present in the market right now, or is there something else that we're going to need to push gold and silver to those prices?
Yeah, I think it's just the degree of the inflation momentum. I think what we're going to see is a combination of a very weak dollar and inflation that is not peaking out but is accelerating. And I think right now you've got a narrative out there. If I were to guess the consensus right now, and particularly after this past week, I think people are thinking inflation is peaking. The economy is not as strong. We had kind of a surge with the reopening, but that the economy is, basically at risk of rolling over, and certainly of moderating a lot. And so that they're not so worried about inflation. And that's what I think has taken the wind out of the sails of the short gold and silver move we had, and I think it's, as usual, Wall Street kind of gets caught in the narratives and then has to, shift back in another direction. So I think what we're going to see here in the next couple months is that the narrative shifts back to, hey, inflation's not stopping here. Inflation's actually accelerating. and the economy does have a second wind here. So we're right back to the worries we had just a couple of months ago, back in probably April, May, that, inflation was a real risk. So I think that, combined with, a dollar that's down towards 85, will be probably the biggest tailwinds. And then, people want to talk about interest rates. I'm calling for rates to move up here, but basically I'm calling for inflation to outpace any nominal, rise in rates. So even though I can see the 10-year moving towards 2% and ultimately 2.5%, inflation is going to be keeping the real rate going the other way.
So in a way, would it be fair to say, David, that the let's say the big time precious metals investors are believing that inflation, this inflation is transitory narrative that we've been hearing at this time?
Yeah, I certainly think that's what this last move down in gold and silver was. I would argue, particularly the miners got hit harder than the metals. I would argue that it was a little bit like March of 2020. I think you don't hear much talk about this, but I think more institutions use these ETFs than anybody's paying attention to. And so I think, and particularly hedge funds, and they're traders. They're not investors. They go into, the gold and silver ETFs and the minor ETFs. And then when the narrative changes in their mind, they're all out. They're not saying, oh, well, I'm going to take a little bit off the table. They're all out, these hedge funds. And I think they're jerking, the prices around. It's the liquidity is not there for hedge funds to be, the elephant in the room going in and coming out. So I think a lot of this is that, we can sit and try to analyze it on a fundamental basis or whatever. I think it has more to do with supply and demand in those ETFs.
So I've heard you speak before about your views on manipulations in the metals markets. Can you explain what you mean on spoofing and what it means versus the broader manipulation of the metals prices? Because I think that's an interesting distinction that you make.
Yeah, spoofing is really kind of scalping a penny here or a penny there, and I think that's going on in markets forever. And so when you hear that, big banks have manipulated the markets, people are taking the spoofing thing that is a reality and extrapolating that out or exaggerating that out into saying, oh, the banks are manipulating the prices, holding prices down because of, X, Y, or Z. And I'm just not in that camp that's the reason the markets are where they are. Or that's the reason why gold and silver have lagged. We had gold go from 250 to 1900 in the decade of 2001 to 2011. I didn't hear anybody talking about how they were manipulating it up. So then you get this long consolidation that has lots of reasons for it, some fundamental, some technical, some other things. And I think it's a natural tendency for people who were expecting, including myself, to see gold and silver, come out of that consolidation long before it did. You had basically a 7 or 8 year consolidation of that decade-long run. But it was a long run. That was a great run from 250 to 1900. So I think you get a narrative out there that gets repeated often, and it fits people's mindset that, oh, those banks are always playing games with us and always, they're not to be trusted, et cetera. And it gets stated by people who are in this business as analysts or what have you, and it gains a life of its own with, presumed credibility. And I'm not saying there's no manipulation. I'm just saying I think we use that as an excuse every time that the gold and silver don't do what we expect it to do. And don't forget, you had probably it's a market where you have, what other market do we have? Maybe some of the MEMS and things where you have investors that are obsessed with it, or in the gold case called gold bugs, people that said, I don't care whether gold goes up or down, I'm holding this through thick and thin. Well, they're not saying that anymore because they didn't expect thin to be 8 years or 10 years. So a lot of them have kind of become a little bit more skeptical of gold and silver. I think it's just all of those things surround the metals, particularly gold. And rather than be able to explain it on a fundamental basis or a technical basis, it makes sense to think, oh, it's manipulation. And of course, we do have a lot of imbalances out there in terms of the big banks, and I presume there's a lot of hedges. I don't know their positions precisely, but the narrative is out there that they're going to be big losers if gold and silver take off. So by that argument, you assume they're going to do anything they can to hold it down. Maybe I'm the one that's wrong, but I'm just not in that camp. I think we're adding 2 and 2 and getting 8. We're taking some things that are true and extrapolating into things that aren't true. And I'm pretty comfortable, because we've seen it in many markets that have been out of favor for a long period of time. I'm pretty comfortable saying this is, more, it's just not their time yet. And let's not forget, they've had big runs. They just haven't had a big run in the last 10 months.
Mm-hmm. So, David, you mentioned narrative there. And I'd like to get your thoughts and maybe have a bit more of a, let's say, an explicit description of how you see the inflation narrative playing out here. You did mention that it could give way to deflation. So can you explain to us how you see this inflation narrative evolving, let's say, over the next this next cycle here?
Yeah, so I'll contrast. My forecast is one thing. What the consensus narrative is another thing. So right now, as I said, I think the narrative is that inflation is peaking for the cycle, and that we've kind of discounted the inflation into the market. Now we have to worry that it's going to come back out. So last week, that was what I think was the start of thinking we got to reprice these for an inflation that's rolling over. My forecast is that that's not the case, that inflation over the next 6 months is going to accelerate, and that it's the narrative that's going to follow that, because narratives follow the market. The narrative that's going to follow that is going to be what we saw a couple months ago, that inflation is breaking out. It's going to be something the Fed's going to have to deal with a lot sooner rather than later, and that's a problem. So I think between now and the end of the year, that's the narrative that's going to flow. You're going to go from inflation's peaking to, oh my God, inflation's reaccelerating, and it's going to be a real problem for the Fed. How that translates into the market, I think initially here, you get a beneficiary of rediscounting, having to discount reacceleration of inflation, and how that will help certain groups in the market. I don't think the reacceleration in the next couple months is going to be so fast that it stops the tech / growth move. So I think you get both move working for a little while. But again, it's you're going to evolve from one view to the next. It's not like you go from one view to the other overnight. So it's in that evolution that some investors will be earlier in accumulating the beneficiaries of inflation. Other investors will be, later accumulators that will help to drive the last move up in those stocks. And other investors are going to be sticking by the growth story because they're not the early adapters of that new narrative. So it's how markets evolve. I think we, particularly on the retail side, investors want to think everything is in a straight line and it's simple. You go from this to the other overnight. Everything evolves. It doesn't happen overnight. So I don't know if that answers your question of what, how I use narratives, or how when I speak of narratives, that's what I'm really looking at is, Nerves help drive markets, but they don't have, it doesn't happen all overnight. It happens over a period of time.
Mm-hmm. So do we get to a point when we see responses from the Fed creating more and more currency where it stops being as effective as it has been to backstop the markets? And is that going to be associated with even more meaningful inflation?
Yeah, I look at it more from the standpoint of it's not so much that it's the money's not as effective or doesn't, the markets don't respond to it. I look at it more as they aren't going to be able to, the unwind could happen so fast that their response, as quick as their response might be, it won't be quick enough. So most of the response will come in reaction to the decline rather than in anticipation of the decline. So in a normal cycle where you don't have the kind of leverage we have today, they might be able to, get in there before the market's, giving up much more than 20 or 25%. In a leveraged system like we have today, that's unprecedented, I think things can move so much faster and deeper before they really get even acting. As I say, it's not just their reaction; it's what's right sized. What's the right sized reaction? So let's say they come in with a couple trillion, and then a couple weeks later, come in with another couple trillion, or maybe but maybe the reaction that they need to have is 10 or 15 trillion. It won't happen all in one. They're not going to. This is so unprecedented. They're as big as what they did last, March of 2020 was, March and beyond 2020, March and beyond that. This is going to be so much bigger. So because the unwind is going to be bigger. So I just think it takes time for consensus bodies, even when they're moving far faster than they've ever moved before, to grasp what they need. I mean, I don't think Wall Street can grasp it. So I don't expect the Fed to be able to, get their hands around it and come up with the right policy. It's gonna again, it's something that's going to evolve. Whether that evolution takes 3 months or 6 months, it's just not going to take 2 weeks.
Mm-hmm. And as you say, in certain cases, they're kind of stuck between a rock and a hard place with the tools that they have available to them, right?
Yeah, the tools they have available to them, and the fact that you don't go from one problem to the other overnight. So you may have both problems at once. You may have inflation accelerating at the same time that the market's decelerating. And what are they going to choose? Initially they're going to say, hey, our job isn't the stock market, as much as everybody wants to accuse them of managing the stock market. They're going to say, we got to deal with the inflation. But somewhere in there, when the market's down 30% or wherever, they're not going to be able to ignore that either. So they're probably going to, and again, they're going to have, I'm guessing they're not going to be waiting for meetings to make their decisions. You will have, phone calls and special meetings, et cetera, as we saw in 2008. So, but it just, I don't think anybody's prepared for what's coming.
So you've been calling for a pullback in the oil price too, David. So why is this, and what is your long-term view on the oil price?
Yeah, my long-term view is that we're going to see 300 plus on oil next cycle. So once we get past the bust and we go into what's going to be an inflation-driven industrial cycle around the world, I think oil demand is going to be through the roof. And more importantly, supply is not going to be there. So you're going to have a really tight supply-demand situation, and it'll drive oil up. But before we get there, we've got this little thing called a bust, and I think it's going to drive demand through the floor. And as a result of that, I think you can get oil back, certainly back into the 20s, and maybe back as low as 10. So I'm not sure whether we'll get all the way back there, or whether it'll be somewhere in the mid-20s. But I think that's where we're heading in the bust. We obviously aren't at the bust yet, so we've got another 6 months to go, where oil could kind of move up and down. I'm kind of guessing we're probably in a trading range between the high 70s. You may not make a new high, or may make a minor new high, with the high being 76. So somewhere in the mid to high 70s is probably the upper band. And, the lower band for the next 2 or 3 months, or 3 to 6 months, I'm not sure, is probably somewhere in the 50s. So you're probably in that kind of a range. I don't know where it goes exactly. I could, a couple scenarios, you could see this thing up to, the low 70s here, come back down to lower lows from what we had yesterday, or whenever the low was the last couple of days. So, back through the mid 60s, back down into the lower 60s, and then rally back up towards the highs with the inflation move. I think we're in a trading range here for the next, until this cycle is over. And then I think with the bust, it'll fall with, pretty much everything pretty hard. And like I said, get back to maybe the mid-20s, maybe, mid-teens, maybe as low as 10.
Mm-hmm. So what role does ESG play in this, let's say this forecast going forward? Does it constrain supply to the point that it helps drive the price here?
Absolutely. Yeah, I think it's a huge error we're making in acting like we can, say by 2035, we're going to be all electric cars, and we're going to be, moving away from fossil fuels. You're going to have, just like we had this clash of an economic shutdown and just-in-time inventories, you're going to have a clash with, oil's a lot harder. The easy oil's been found. Mm-hmm. The much harder oil is the deep water, et cetera. And you're going to have, and that takes time to develop the infrastructure for all of that. At the same time, you're closing down pipelines. You're discouraging fossil fuels in a lot of ways. So I think we're going to have a situation where, when the economy reopens because of this huge fiscal and monetary stimulus response to the bust, you're going to have several years where you have, just like we've had, I think this last year is a microcosm of what we're going to see, except in a much bigger fashion, worldwide demand through the roof. And you just can't turn on the spigots. We're going to have peak oil. I have no doubt. You get out to the mid 2020s, and peak oil is going to be the story of oil again. That oil supply has peaked and demand's through the roof, and the only thing that can go is price. It will stimulate, deep water drilling and other things. They're not going to be able to walk away from it, because you can't fill the demand with solar or wind or any of the other alternative fuels. It's just not going to be realistic. So I think for this decade, fossil fuel is still going to, it's going to come front and center, and it's going to be a very big short supply versus demand story. And that's why I say 300 plus on crude. And I don't know what plus is. Is it 350? Is it 450? I don't know. But I think it's going to be a big number. But it'll be coming from as I said, a lower place from here. So, could be, coming up from 10 or 20.
And as you say, not necessarily just from an energy standpoint, but even a raw materials standpoint, the amount of oil that we need to produce all of these plastics and all of the parts that go into the windmills, electric cars, all of that stuff, that's a huge demand component as well that can't be replaced.
Yeah, if you fast forward to the middle of what I am calling the worst economic downturn we've had in the post-World War II era, so worse than 2008-9 across the world, including China. And then the decision is we've got to do fiscal and monetary stimulus to pull us out of that. We're already seeing that fiscal stimulus is going to be very oriented towards infrastructure, towards everything from electric grid to roads and bridges to the electric vehicles and other alternative usage. So you could see that it's going to be an industrial recovery. It's not, you'll get some of the stimulus to the consumer, but it's going to be a whole different cycle than we've had. And industrial cycles, we haven't had one in 40 years. Industrial driven cycles demand a lot more energy. So I think that too is going to be part of that demand side. And I think it's a collision course that can't be avoided.
Mm-hmm. And you've mentioned several times this industrial driven recovery, David. So can you spell out what you mean by that a little bit more?
Yeah, just kind of what I just said. I think it's because on the fiscal side, a big part of the stimulus is going to be aimed at infrastructure. Infrastructure is industrial. And at the same time, I think we're going to have reshoring in this country, particularly if we have a change in administration in 2024. I think you're going to see, a lot more movement on the part of companies saying we won't, supply chain issues and everything else we've seen, geopolitics tells us it's not worth it to just look at the cost structure when we determine where we're going to build plants or where we're going to build our business. So I think, we certainly know it's the case in chips, right? I mean, there's real fear about the dependence on Taiwan and China and Asia for our chips. And so you're going to see that happen, more plants being built here for that. I think we're going to see it in autos. I think we're going to see it in steel. I think we're going to see it in a lot of places that we are going to come back this way. Now, I don't know how fast. I don't know what the politics will be. But I think at the margin, that's going to be part of the industrialization of the next cycle. And then on top of that, like I said, it's just the whole government spending is going to be towards infrastructure, which means industrial rather than, in the past, what have we done? We've stimulated housing. We've stimulated consumer spending. The consumer, if I'm right about this market, the wealth effect is going to be pretty big. And it's going to take some time to dig out from under, if we have a 70 or 80% hit to the market, and if we have, big jump in unemployment, et cetera, those first couple of years out of the trough, the consumer is not going to be in the kind of shape where they can just say, hey, we have pent-up demand, we're going to go spend. I don't know if it's all going to work out that way, but I think the tendency will be that industrial will be a bigger component of recovery than we've seen in the last 40 years.
Mm-hmm. So, David, as we wrap up here, would you mind sharing with us your targets for the metals and mining indexes for this year?
Sure. I'm looking for gold to 2,500. And then, like I said, it can correct in the bust back probably towards this area. Maybe it comes back to 1,800. Maybe it only gets back to 2,000. On silver, 45 to 50. Silver's a more economically sensitive metal, so I'm guessing the volatility to the downside in the bust will be greater. But again, if we're up at 50, it probably doesn't get much below 30, 35, so it's above here. Maybe it does, maybe it gets back here, but I just don't see from these levels a lot of downside risk, even in the bust. Downside risk from where they get to, but not from here. And in terms of the miners, I think the small miners will outperform the majors as they usually do in bull market runs. I think you could see the small miners certainly could see doubles or more from current levels. And the majors probably, 75% upside from here. Mm-hmm. And then again, that's just for this year, and it could spill over into next, but probably this year. After the bust, I mean, it's many, many multiples of where we are today. I mean, if gold goes to 10,000 plus, and that plus could mean, 12,000, 15,000, I have no idea. If silver goes to 300 plus, and that could mean 400 or 500, I have no idea. You're talking miners that can go up tenfold or more, maybe much more.
And as you and I have spoken about before, you were saying that the miners will ultimately become almost like the next .com bubble, right?
Yeah. I like to say that the miners will be to the next cycle, not now, but after the bust, to the next cycle, which is probably 2023 to 2029, something like that. Will be to that cycle what .com was to the 1990s. And it's been a long time since we've seen, and all commodities will play very big, but I think they'll be the top of the list in terms of, inflation beneficiaries, and kind of the dollar after its big run during the bust will be under pressure for the rest of the decade. All of those things will play well for the miners, I think.
Excellent, David. Do you have anything else you'd like to add before we conclude here?
Let's see. I would just say people should be cognizant of the fact that we are 39 years into a secular bull market. So as much as there's, maybe as much as 15 to 25% upside in the melt up, depending on which index you look at. And that's, normally an annual or 2-year return. Just know you're getting awfully close to what I think is the other side. So, just kind of looking forward, know that it's going to be harder to sell at the top because everybody's going to be giving you a bullish story. Know how psychology influences markets, and be aware that, if you get too greedy, you may be surprised at how fast your profits disappear. Mm-hmm.
Excellent, David. And of course, you're available on Twitter at Dave H. Contrarian. And you also write a quarterly letter by subscription, right?
Yes, that's exactly right. If anybody's interested in the letter, it is by subscription, which means there's a cost to it. You can direct message me on Twitter, and I'll be glad to get right back to you.
Excellent, David. Thanks so much for your time today.
Okay, thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.